for hospitals and testing. I know we have a number of bankers on the line, so we just want to mention, if you weren't aware, there's 60 billion that's been earmarked for small banks, and our understanding of what that's defined as is that 30 billion will be available to banks with 10 to 50 billion in assets, and another 30 billion for those banks with under 10 billion in assets. So again, I know this is the Main Street program, but many of you have been very, very involved with the PPP, so I wanted to give that update. One other comment on the PPP before we move on is that I'm sure you're all aware, if you've received a loan or hoping to get one in this round, that there is a loan forgiveness component. And we have another group that's working on putting together a presentation on exactly how that works and the mechanics. So we'll hopefully have that prepared fairly soon, and we'll be sending out an invite for that. So I want to move on to today's program, again, the fundamentals of the Main Street Lending Program. And first wanted to just do a brief introduction. Many of you know our firm very, very well, some not so well. So just kind of very briefly, we are the largest local CPA firm in Houston. We've got about over 300 people in our firm. We actually have offices here in Houston, Woodlands, Austin, and El Campo. In addition, part of the team that's been working very hard on this and the other programs is we have a subsidiary company, Briggs & Maselka Capital Advisors, that does traditional investment banking, but has been very, very helpful in this entire process. So they've been part of the team and really done a great job in helping us out. Many of you know Sid Shaver, who's the managing director of that. So feel free to reach out to Sid if you have any questions. Just briefly, our team that's working today, Carrie Kilgore is an audit partner with us. I'm Bob McDonald, tax partner. Eric Deal is a director with Capital Advisors, and Lincoln McKinnon is an audit principal in our group. So our objectives today are to discuss the new Main Street program, who's eligible for it, the loan facilities information, what are some of the terms of the loans, some of the key factors, and then additional requirements. So before I turn this over to Carrie Kilgore to speak a little bit, I'm going to change hats here and man the Q&A section. And we do have should be a button on there. You can, if you have a question, feel free to send it in so that I don't have to put this caveat on every answer. I will say that the Federal Reserve requested comments. They've received 4,000 comment letters and they have not responded. So we certainly expect some changes, but we thought it was important to go ahead and let you know what the program looks like right now and what we think. But again, understanding that I think it's highly likely some things will change on that. So we're here to help. If there's anything at all we can do, please send in the question. If we can't get to the question today, or if we don't know the answer, which I certainly kind of expect some of them we won't, we will be posting these questions and answers. We'll be working to find the answers and posting them on our website. So with that, I'll hand it over to Carrie Kilgore to talk about the Main Street program.
All right, thank you, Bob. I want to thank everyone for taking some time out of your morning to be with us here today. And I hope that wherever you are in the country, you are continuing to be safe and well. So we're all here this morning because you've at least heard something about the Main Street Lending Program. This was delivered under the CARES Act, which was actually issued on March 27th. And the Fed unveiled the general details about the Main Street Lending Program on April 9th. Now, this is a lending program with total availability up to $600 billion in loans that will be made through a special purpose vehicle. Now, the comment period was open from April 9th to April 16th, and as Bob mentioned, the Fed received over 4,000 comment letters, and none of those have been responded as of today. So the application start date is still unknown. There is some speculation that it could be as early as May 1st, which is a week from today. We tend to think that that's a little bit aggressive and that it will probably be more likely early to mid-May before the application process opens up. And then from a funding standpoint, if the PPP is any indication, funding could be anywhere from a matter of days to a few weeks. And currently the program is set to expire as of September 30th of this year. Now, that could be deferred, but as of now, it is September 30th. So just the Main Street Lending Program, as you know, the PPP was really focused on small businesses and was fairly limited as to who was eligible. And the Main Street Lending Program is aimed at more of your larger middle market companies. So next slide, Julie. So as I mentioned, so the PPP was limited to companies with 500 employees or less. The Main Street Lending Program is up to 10,000 employees or 2.5 billion in 2019 annual revenue. Other restrictions is the company must be a U.S. domiciled business with the significant amount of operations within the U.S. Businesses that are eligible for the Main Street loan, even if you've applied for the PPP, you're still eligible to apply for the Main Street. We want to encourage you, anyone who obviously was in for the first round of the PPP, some may be waiting for the second round of the PPP. We definitely want to encourage you to continue to go down that route, simply due to the fact of the 100% forgivability on the PPP loans, whereas the Main Street loans are not forgivable. So definitely exhaust those options before moving on to the Main Street options. Next slide, Jillian. So there's two facilities underneath the Main Street Lending Program. There's the new loan facility and the expanded loan facility, and we'll get into a little bit more details on both of those here in a second. You may only participate in one facility. You cannot participate in both. Now, as the SBA loans were 100% guaranteed by the Fed. Now, these are only 95% guaranteed. They're purchased through a 95% participation through special purpose vehicles, with 5% of the loan amount being retained by the bank on the bank's balance sheet. So that is a pretty significant difference from the PPP loans. And even though that sounds, 5% sounds like a nominal amount, as you'll see, these loans are significantly larger, or potentially significantly larger than the loans available under the PPP. Some common loan terms between the two. For now, there's a minimum loan size of $1 million. Some of the comments that we've seen coming through have been requesting for that loan size to be reduced, but as of now, it is still $1 million. There's a 4-year maturity for both loans, with principal and interest deferred for 1 year and no prepayment penalty. Okay. So let's talk a little bit about the new loan facility. Now, as the name suggests, this is a new loan origination. It can be with an existing bank, but it would be a new loan. It is completely unsecured, no collateral required. The maximum loan size is the lesser of 25 million, or an amount that, when added to the eligible borrower's existing outstanding and committed but undrawn debt, does not exceed 4 times 2019 EBITDA. So in an instance where you had $5 million revolving line of credit and $3 million outstanding, 5 million is the number that you would use in this calculation. And another way to word bullet point number 2 here is that this is really the delta between 4 times your EBITDA and your total outstanding but undrawn debt. There are fees associated. There's an origination fee that the borrower pays to the lender of 1%. This is fairly standard. There's a facility fee that the lender pays of 1% to the special purpose vehicle. And now this fee can be passed through to the borrower. That's really at the discretion of the bank. And there's a service fee where the SPV will actually pay the lender a 0.25% annual fee based on the participated amount. So let's walk through an example of the new loan facility. Now, for presentation purposes, this has been simplified, but this will help us kind of get through it. And so the first thing we need to do is figure out what the assumptions are. Now, in this example, we have a revolver with a total line of $7.5 million and 3.75 outstanding. So as we said, it's the total amount of the revolver that's included in the calculation, so 7.5 million. And then you have a term loan for 5 million. So you have total debt outstanding of 12.5 million. And then a 2019 EBITDA of 5 million. So then you move down to step 2 to calculate the the new loan facility borrowing capacity. So the max borrowing capacity here would be 4 times your 2019 EBITDA, so $20 million. And then you would subtract from that your current committed and outstanding bank debt of 12.5 million. So the new loan facility borrowing capacity in this example would be 7.5 million. And then you go to the final step, which is to determine the new loan facility loan amount, and you would take the lesser of the cap of 25 million or the borrowing capacity of 7.5 million. So in this instance, the loan amount would be the lesser of those two, which would be 7.5 million. Now I wanted to see, this is, I don't have a slide for this, but let's just assume that your 2019 EBITDA was 15 million. So then your maximum borrowing capacity would be 60 million, which would then leave you with a loan facility borrowing capacity after subtracting the debt of 47.5. So in this instance, then you would go to step 3 and you have the lesser of the cap of 25 million or the borrowing capacity of 47.5. So in that instance, your loan amount would be 25 million. So you can see what a significant driver EBITDA is to this calculation. So next slide. Now let's talk about the expanded loan facility. Now this would be a loan that is added to an existing credit facility with an existing bank. There's no new collateral required as part of this loan. It would still be the existing collateral on the existing loan. The maximum loan size is the lesser of 150 million, 30% of the eligible borrower's existing outstanding committed but undrawn bank debt, or the delta between 6 times your 2019 EBITDA and that debt number. The fees are similar. The 1% fee paid to the lender. The SPV pays the lender a 0.25% annual fee. There is no facility fee paid to the SPV as part of the expanded loan facility. Next slide. So to calculate the expanded loan facility, we're going to use the same assumptions that we used for the new loan facility. So we've got a total outstanding debt of 12.5 million and a 2019 EBITDA of 5 million. Now for the expanded loan facility, you look at 6 times EBITDA, so that your max borrowing capacity would be 30 million. Current committed and outstanding bank debt is 12.5 million. So the expanded loan facility borrowing capacity would be 17.5. So then you go to step 3 to determine the loan amount, and it would be the lesser of the cap of 150 million, the expanded loan facility borrowing capacity of 17.5 million, and then 30% of your committed and outstanding bank debt, which is 3.75 million. So in this case, your loan amount is 3.75. And so I think it's important to see that using the exact same assumptions, the new loan facility would allow the borrower to obtain a larger loan than the expanded loan facility, assuming these assumptions. Now let's assume, so on the new loan facility, we change our EBITDA to 15 million. Let's do the same thing here. So if you have a 2019 EBITDA of 15 million, that makes your max borrowing capacity 90 million, subtract your current debt of 12.5, get you to an expanded loan borrowing capacity of 77.5. So then you go back down to the loan amount is the lesser of the cap of 150, the borrowing capacity of 77.5, or 30% of your committed and outstanding bank debt of 3.75. So even changing the assumption, increasing your EBITDA from 5 million to 15 million, your loan would still be limited to 30% of your bank debt of 3.75 million. So I think it is important to determine which one of these loan facilities makes more sense for you, the new loan facility or the expanded loan facility. And I think it's prudent to do some research and some preparation ahead of time, work with your bank, determine which loan facility makes more sense for you. And definitely, if you have the capabilities of doing that in-house, or if you need to have a service provider come in and assist you with those calculations, I think it definitely makes sense to be prepared and to know which one of these loan facilities is best for you in your current situation. Next slide. So this is really just tying it all together, comparing the new loan facility and the expanded loan facility. all the terms here, as mentioned above, which we just went over, so I won't go through those again. The common terms between the two, there is a maturity of 4 years. As mentioned, the principal and interest payments are deferred for 1 year. The interest rate is it's an adjustable rate, the secured overnight financing rate, which was 0.01% as of 2 days ago, plus a range of 250 to 400 basis points. Current minimum loan size is 1 million. And as mentioned, that could go down as part of the Fed's response to the comments, but as of now, it is still 1 million, and there is no prepayment penalty on either facility. So at this point, I'll go ahead and pass it over to Lincoln McKinnon, who's going to speak on some of the restrictions to the borrower and other items.
Thank you, Kerry. So I guess picking up where Kerry left off, you know, I guess what everybody needs to understand that there are going to be certain restrictions and attestations that all individuals or borrowers that are looking to get these Main Street loans will have to follow. From a purely attestation standpoint, the two things that you must attest to of getting these loans is number one, that you were required to get this loan due to the circumstances brought on by the COVID-19 pandemic. In addition to that, similar to the PPP program, you know, the borrower should make a commitment to make reasonable efforts to maintain the payroll and retain employees during the term of the loan. The restrictions are a little bit more interesting, and there are 4 that you must follow as a function of this lending program. These were rolled out, and these are the same restrictions that are in place for all lending programs under the CARES Act. The 4 main ones being stock repurchase limitations, capital distribution limitations, compensation increases, and limitations on debt reduction. So in efforts to keep the slides fairly clean, we didn't put all of the restrictions on there, but just to go over them briefly. Basically what those stock repurchase restrictions are letting the borrower know is that you are not able to repurchase any equity securities of the borrower if those securities are listed on the National Securities Exchange, any National Securities Exchange, with the exception to any contractual obligations that were already in effect prior to the passage of this act. I also wanted to note that in addition to the borrower, stock repurchase restrictions are also in place for the borrower's parent company, which is also something significant. With regard to distribution restrictions, what it says in the CARES Act essentially is that a borrower may not pay dividends or make any other capital distributions with respect to its common stock. And as we noted, the comment period did just end on April 16th. There was a large number of comments that came out of that. We are all expecting some changes to come out after this comment period is over. And one of those changes that seems to be commonly expected is that there will be some level of expansion with regards to the other equity interests that are also incorporated into this. So what I would say is if that's something that is of particular interest to you, make sure that you stay up to speed on any changes that are going on, and obviously we'll do everything we can to assist you with that. Compensation increases are also somewhat interesting. There's 2 thresholds really that come into play when talking about compensation. It's the $425,000 threshold, and then there's a $3 million threshold. But essentially what it says is that if an employee, all employees, if you make more than $425,000, and this all follows a calendar year, so during calendar year 2019, if an employee or an owner made more than $425,000, they are not allowed to receive compensation in excess of that amount during this restricted period. And I did want to note that the restricted period for this loan is not exactly at the time of payoff. You're actually restricted from these activities 1 year after the full repayment of any debt that you have regarding the Main Street Lending Program. The $3 million threshold says if you have an employer or officer whose 2019 comp exceeded $3 million, total compensation cannot exceed $3 million plus 50% of his or her salary over $3 million based on their 2019 compensation. So the main thing for that is that if this is something that might impact you as a borrower, you'll want to make sure that you review your employee agreements, confirm that they can comply with these restrictions without breaching any of those agreements. And it might be prudent to seek any waivers or amendments under those agreements if that is something that's causing you any particular concern. And then the last restriction, it really is comes down to debt reduction. The debt reduction restriction is a little cloudy, but how it currently reads is it says that a borrower will not repay other debt of equal or lower priority, with the exception of mandatory principal payments, unless the borrower has first repaid the program loan in full. We don't have a clarification on what equal or lower priority currently means. That is one of those changes that we do expect to come out of it. But that's just the general overview of the restrictions and the attestations that you should be willing and ready to abide by should you, should this Main Street lending program be an opportunity for you. On the next slide, we have a couple of practical considerations that we wanted to put by you, really just from the lessons that we've kind of learned through the PPP and EIDL program. Like we stated earlier, this program isn't live and we don't know what the full demand for it is. We do know that as it currently reads, it's capped at a certain size, being $600 billion. And in the current economic state, that money might have the tendency to go fairly quickly. What we learned in the PPP program is essentially the reason that they haven't rolled out the Main Street lending program is because we had to double back on the PPP program and make sure that the individuals who were not able to get their loans processed for whatever reasons, still had access and availability to these much needed funds. With that being said, the borrowers that we work with that were able to get through that PPP program seem to have done a really good job on being prepared the second that it rolled out and getting their applications maybe a little bit further ahead of the line than those individuals who spent those first few days trying to gather that information. So preparation will play a large factor in their company's ability to get involved in this program. We do think that the use of the 2019 calendar year information, not any trailing information or anything like that, will be somewhat of an added benefit, especially due to the size of these loans. The EBITDA calculation itself shouldn't be foreign to most of these borrowers, and it should be fairly simple to come up with. As Carrie kind of alluded to in those slides, it seems like more of the work and more of the detailed calculation will be involved in the debt covenant or the debt calculation thresholds associated with these loans, and really determining which program might be the best suit or best fit for you. So on the next slide, what we have essentially is a few items that we're expecting clarification on once this comment period closes, or should I say once we start receiving guidance after the comment period. One of them is for the maturity for the expected loan facility. Currently, how it reads is that the expected loan facility should follow the same terms as the new loan facility, which is a 4-year period. This expected loan should be in addition to the existing loan. So the clarification really is, does the $4 million or does the additional amount from the expected loan facility only need to follow the 4-year maturity date, or does it alter any of the original terms as well? The meaning of the bank debt and the 30% size limit testing is also something that we expect a little bit of clarification on. The meaning of committed but undrawn debt is also something. Distribution and equity repurchase issues might come up. There's always some nuances associated with that, and currently it reads that none of that is acceptable, but we would expect that there would be some exceptions to that rule. Just don't know what they are now. And then obviously, what does equal or lower priority mean with respect to debt repayment? Two that should be of particular interest, and I know the last one is for certain, with our customers, has been the affiliation rules and the rules surrounding foreign ownership. Now, there's been some cleanup that's needed to be done over the course of this comment period, just from things that were learned from the PPP. And one of the desires of Congress or the people who've passed this particular act is they want to make sure that the individuals who need this money most are the ones who are getting it. So trying to limit the number of large or multinational companies that might be able to slide in under the way that the rules are currently written. So we do expect that private equity and venture capital firms will be eligible to participate. Some of them were left out of the PPP program, really more so as a from an effect of the size limitation. So with the expanded size of these loans, we do expect that there will be a large availability for private equity firms to participate. But we are awaiting some clarification in regard to the affiliation rules. I would be remiss if I did not let you know that we are here to help. Obviously, the reason that we put this, and this is on the next slide, Jillian, the reason that we put this presentation together was purely for informational purposes, to make sure that our customers and anybody else who our referral sources, anybody else that we work with, really had the information they needed to navigate this program, knowing that the information is coming pretty quickly, and we just wanted to get it in an easily digestible format, which we hope we've done for you. But besides the information, obviously we are always here to assist in any way that we possibly can. We mentioned Briggs & Weselka, the capital advisors. They can assist with any sort of strategic advisory services that you needed, whether it be recapitalization or restructuring. Obviously our tax department is here to assist with tax implications and any planning that you have. I am Lincoln McKinnon. Again, I work as an audit principal primarily in our financial institutions practice. But on the audit side of things, we can assist with any agreed upon procedures. If there's any discussion or consultation that's necessarily needed for the accounting treatment for financial institutions, myself and my colleagues can serve as a good contact for that. If you have any reporting requirements for any PG portfolio companies, we can also assist with that. And obviously, we are well-versed in public and private company audits. I could not leave you without some resources. Obviously, knowing that all of this is still coming together, what we will continue to do is, monitor, the news alerts as they come out, make them available on our website, which we've provided a link for you above. The Briggs & Weselka website with the industry insights with COVID-19 is always going to be a good place to go just to get the most current information about any of these programs, including the PPP or EIDL loans. The Federal Reserve website, being that they're the ones who rolled this program out, the link that we provided is really informational. It seems to help. They also have some common term sheets that are out there, and they seem to be doing a good job on updating this as information becomes available. So I would also advise you, if this is something of particular interest, to maybe save this as a bookmark in addition to our website, and monitor those too, and they should both keep you pretty much up to speed with everything that you need to know. The SBA, some other resources that we have are the PPP and EIDL funding programs, which really we're just using as a learning tool, because it's, all of this information came together really quick. Congress is working, through the night most of the time, trying to iron out some of the details. They did do a good job on rolling these programs out, but with that being said, there's always hiccups whenever you rush things. So they are making modifications from lessons learned from PPP and EIDL funding programs, and kind of implementing those into the new programs, including the Main Street lending. As a top 100 firm, obviously, we do have the benefit of having a direct line to the AICPA. So I know that our managing shareholder and our executive committee have raised issues and received some good information from the AICPA with regards to implementation and just some general nuanced questions that might come up. So if you do have any questions, I would really advise you to either use the link that we've provided, maybe submit your Q&A over this particular webcast. We'll gather that information. If we don't have the immediate information, at least we do have the tools and resources to be able to get that information and get you a response back. Like I said, I work in our financial institutions practice. In addition to the mutual funds, investment clients, and insurance agencies that we work with, we do have a fairly strong banking practice as well. Works with about 100 financial institutions, ranging in size from 100 million to 20 billion. So we will continue to have our contacts with them. I probably spend an hour or so on a phone call every day with one of the bank CEOs or CFOs, really just trying to figure out how they're implementing this program, knowing that they're on the other side of it, not the borrower, but the lender. and then obviously the industry associations that are also involved. So as not to take too much of your time, if you do have any questions, please email us at the email provided. We know that more information will be coming out, and similar to what we've done with the PPP and idle programs, we will roll out a FAQ to all the individuals who are likely registered for this webinar, and continue to keep you up to speed on that and do our job as your CPA and advisor. So with that being said, it's probably a good time to open it up for any particular questions, any additional information you might have, Carrie.
Yeah, thanks, Lincoln. Bob, I don't know if you were planning to address any of the questions audibly, or if you're just responding to all. So I'll give you a chance to jump in if you want to.
I think I've actually been able to catch up and respond, but you know, certainly there were a couple questions I might pass to you guys regarding the leverage portion of the debt. That, you know, is shareholder payable, for example, included in that as an only commercial bank debt? You know, what about a factoring line? Some other variations, leases, and I don't know that we have a great deal of guidance, but just wanted to throw that out to you guys for any comments you may.
Okay, yeah, I mean, I know that there's still, you know, a lot of information that we're waiting to get back as far as the definition of the debt that's included in these calculations. I know one question was if it's only the unused portion or if it's the entire debt. I mean, for the leverage calculation, it is the outstanding debt plus any unused portion would be the number that would be used in that calculation. So my example of a $5 million revolver with $3 million outstanding, $5 million is the amount that you would use.
Yeah, and then just to add a little bit on to that one, I see the question about the determining the borrowing capacity and what debt is relevant. That is one of those questions that I have seen pop up in multiple places that hasn't quite been clarified at this point. You know, does it include all those additional aspects that are mentioned, such as shareholder loans or intercompany loans? As of right now, it is only really talking about bank debt, but I could see how they might fold that in from a leverage ratio calculation. Again, that would be something that we would expect to hear some comment back on that period.
Yeah.
Let's see here. With regard to the committed, the debt that Carrie was just talking about, it talks about that you have to have all drawn debt plus committed debt. And the clarity really needs to be surrounded on the committed portion of it. So if I have a $10 million line of credit and I've only drawn 3, I still have 7 million available. Is the guidance saying that if you have 2 million that's already kind of spoken for from a CapEx perspective that you have committed to, that needs to be included? Or is it saying that you need to include the 10 million? Those are a couple of the questions that I've also seen submitted as a function of this comment period that we would expect some clarity on. So nobody's off base for the questions that they have. We're just kind of in that situation where this program did just roll out. And in addition to that, with the doubling back on the PPP and really that just getting passed last night, we do expect a significant amount of attention now to be shifted towards this Main Street lending program, because it seems like it may be a good tool for oil and gas companies, from what I've seen, to kind of bridge this time period where they're hoping that these are just temporarily depressed gas prices.
We've also had a couple questions regarding where people can get the slides. So if one of you wouldn't mind letting people know where the slides will be available for them.
I believe that our marketing department, that Jillian will email those out to all the participants or make them available on the website, but we will provide some clarity for that. Everybody involved in the phone call will receive the slides though. I do see a question that's open out there that talks about, are there any affiliation rules associated with that? Just similar to the PPP program. There are some affiliation rules. We're expecting that the same affiliation rules that apply to the PPP program will also apply to the Main Street lending program. But with that being said, with the loan size amount being larger, and the revenue and number of employees being larger, we do feel like it will be able to capture a large number of companies that were left out of the PPP program, just basically as a result of those affiliation rules and having to include the revenues and the employees of those affiliates. So I believe, Bob, that those are all the open questions that I see out there. What we will likely end up doing is taking these questions, these answered questions as well, incorporating them into our FAQ. That way, the individuals who may not have had a chance to kind of read through all of those and see the answers will at least be able to have access to those after this webinar is over.
Right. As Lincoln said, obviously it's frustrating to us not to be able to answer all your questions. We know this is very important and a lot of moving parts, but just want to be assured we do have a task force. We're watching this every day. We're trying to get answers and we will be posting them. And if you do have additional questions, don't hesitate to reach out to any one of us and we'll do everything we can to help you.
Let's see here. It seems like there are a lot of questions coming in, so I don't know if we want to leave this open for a few minutes and try to get those answered, or if it's best to include that on the FAQ. I'll defer to you guys.
Probably follow up on an FAQ so we can have a little time to look into these.
Yeah, I see a lot of questions about affiliation rules and also with the factored line of credit and just really going into that debt calculation, which was really my expectation going into this and really coming out of it, having looked over a lot of the questions that have been submitted so far. So again, you know, we will make sure that we kind of monitor these, knowing that these are really going to be the sticking points, and make sure that we keep you up to speed. I did see a comment about making sure that the slides are available. And you know, the three of us will take a personal accountability and make sure that that gets done for everybody who took the time out of their day to make sure that they learned a little bit of information from us. And hopefully you all found it helpful.
Carrie and Lincoln, it's Jillian. I'm on the marketing team and I will make sure all the slides are sent out to all the participants, and then we'll also address all the open FAQ questions. And I think we can wrap it up for today.
Sounds great.
All right.
Thanks to everyone for attending.
Thank you, everyone.
Thank you.